Thank you for joining this Inform Me webinar about financial statements. I'm Tamsyn Jefferson-Harvey, and I've been running my own accounting practice, Seed Accounting Solutions, for almost 7 years, and I specialise in small business growth. Today, we're going to look at how you can quickly identify key insights from your financial statements. This is a taster of what you'll learn in the AAT Business Finance Basics e-learning courses, but we can cover that a little bit later. Today, we'll be looking at how to gain key insights from your financial statements to give you an idea on how your business is performing and what you can do to drive your business forward. First, I'll cover some of the key financial statements in your business. We'll then be going through the profit and loss and balance sheet in more detail and the insights you can gather from these reports. We'll finally go through the key takeaways from this video and other resources to help you on your journey. So what are financial statements? The key financial statements in any business are the profit and loss, balance sheet, and statement of cash flows. You may see these reports under different names, however, they are fundamentally the same. Different software and templates may also present the data slightly differently and in different levels of detail. However, the information they show are basically the same. 6 reasons why they're important. Here are my top 6 reasons why you need to be able to understand your statements. Firstly, they tell the story of your business, allowing you to interpret the results of your business activity. Secondly, this helps you identify the symptom versus the root causes. For example, a decline in gross profit is a symptom of many root causes such as ineffective pricing, rework, poor purchasing, wastage, and so on. 3, knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. 4, areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. 5, understanding your numbers also means you have reliable information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. So first, we're going to cover your profit and loss report. This is also known as an income statement, and it shows all your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period with adjustments made for timing differences, for example, sales that have been made, but the money hasn't yet been received. It's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation. You must also ensure that you have sufficient profit to cover cash costs such as loan principal repayments, asset purchases, drawings, tax liabilities. There's a whole host of things that don't show up on your profit and loss statement that you need to include. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years or months or quarters to compare your business performance to similar businesses. Businesses are generally valued using a multiplier of earnings, so your profit and loss statement is a fundamental driver of the value of your business. The higher your earnings, the higher the value of your business. So here is a basic profit and loss report. As I mentioned, this has been downloaded from the Inform Me website. These will look very different based on softwares, templates and however you want it to look like, and different accountants may also choose to lay it out differently. Depending on your business, you may also have different levels of detail in your profit and loss report. But ultimately, you have your sales at the top with your direct expenses or your cost of sales underneath, and then you get your gross profit. Underneath your gross profit figures, you'll then have your operating expenses. These may be grouped, as in this template, with sales and marketing and general and administrative, or it may just be all in one section. You'll then have a total of these operating expenses at the bottom. And then finally, you have your net profit and your percentages for your gross margin and net profit margin at the bottom. First, we're going to look at the sales on your profit and loss report. The first thing that you're going to look at is, have you achieved what you expected? Have you achieved the growth that you anticipated? How did it compare to last year or previous periods? When checking my own or advising clients, I always compare the last 12 months against each other in addition to the annual comparison. It highlights seasonal fluctuations, costs that may have got out of hand, opportunities to drive sales a bit more, or capitalise on quieter periods to focus on marketing. We're just going to look at my profit and loss spreadsheet again, and I can go through some of the data in real time. So just looking at our profit and loss report here, we have last period, we've got budgeted figures here, and we've got the current period as it stands. This can obviously be a year or a month, or however you want to look at it. These figures I've done based on an annual turnover. So if we're looking at sales revenue, this period we've done 42,321 of product or service 1, 16,843 of service 2, and 2,753 of service or product 3. This gives us total sales of 61,917. So we've come in above budget and we've done better than we did last year. However, if you look at the figures in a little bit more detail, you can see that obviously product service 1 has done incredibly well. Product service 2 has also performed much better than anticipated and on last year's figures. However, product or service 3 has done less well. Now, using this information, you might want to decide whether you're going to drop product or service 3 entirely, what you could do to improve the sales in order to meet your budget. If you're looking at these figures partway through your year, it might be that you need to work a little bit harder to drive that third service or product, or it might be that you just need to readjust your budgets and your expectations. And actually, overall, the business has performed better than expected on its sales figures anyway. So those are some of the things that you could look at with your sales figures in your report, whether it's on a monthly or an annual basis. So next, we're going to look at the margins on your profit and loss. I mentioned a couple of slides ago about the two different margins, gross profit margin and net profit margin. Your gross profit is calculated by deducting your cost of sales from your sales. If you want to show this as a percentage, you would then use that figure and divide it by the sales to get your gross profit percentage. Your gross profit margin is used to check that you've priced your service or your product correctly. It can be used to monitor your direct expenses and make sure that they are consistent and you're getting a good price and they are the correct price for the price that you're selling your product or service at. It can also ensure that there is enough gross profit to cover your operating expenses. When you're looking at your profit and loss and you're looking at your gross profit figures, the first thing that's most important is your gross profit enough to sustain the overheads in your business? Again, compare these to prior years and see what was different, especially if in previous years your gross profit margin was higher. You might want to look at what's changed and what you need to do to improve your gross profit margin. Secondly, if your gross profit looks low, are you charging enough for your services or your products? Or are the costs of delivering these services or products too high? Secondly, looking at your net profit. So your net profit is calculated using your gross profit less all the operating expenses or overheads. It's the same thing, it's just a slightly different term. The net profit is used to check the profitability of a business and check that you've got enough profit to cover drawings, loan repayments, asset purchases, tax payments, and other liabilities. Did you make a profit or loss? That will be shown on your net profit figure at the bottom of your P&L. If you made a loss, do you know what caused this loss? Was it low sales? Was it a low gross profit margin? Was it your overheads were higher than expected? Did you have incorrect pricing in your business? If you made a profit, is it enough to cover the liabilities in your business? We'll just jump back in to the spreadsheet now and we can go through those gross profit figures and net profit figures in more detail. So looking back at our profit and loss report, your gross profit figures are calculated here. So they are your sales less your cost of sales, and you have your figures here. Now, at first glance, it seems that your gross profit has increased. Now, the figure of the gross profit has indeed increased on the previous year. However, it is lower than what was budgeted. What you really need to look at is actually whether your percentage has increased or not. And in order to calculate your percentage, you would take your gross profit figure and divide it by your total sales. And then you multiply it by 100 and you will have your gross profit percentage. So in this case, in last period, it was 38%. You can then copy this across to the other columns. And as you can see, the budgeted gross profit was actually 43%, but we've only achieved 41%. So whilst we have improved on last year, we haven't quite met the budget of 43%. However, it is still an improvement on last year. So this is your gross profit percentage. You may wish to show that as a percentage. Take off 100%. That's worked. There we go. This is then much clearer. If you know that you want to work towards a gross profit percentage of 40% or 43%, you'll need to look at, again, either increasing your sales prices or your sales volume, or decreasing the cost of sales figures. Then we go down to your net profit. Obviously, if you download this template, you will actually have all the percentages ready to hand at the bottom. But just in case you're using your own spreadsheet, that's how you calculate your gross profit. So the net profit down here is calculated by taking your gross profit figures and deducting these operating expenses from that, and you get your net profit figure here. So the net profit margin is down here, and as you can see from this formula, it is in fact the net profit divided by the total sales figure. And you get your figures. So as you can see here, we budgeted 26.3% and we have ended up with 26.1%. So we weren't far off the budgeted net profit figure, and we have improved on last year. As you can see, in this case, this profit and loss is showing a profit and not a loss. And therefore, this is what is able to be used in the business to pay off your loan repayments, any tax liabilities, and any drawings that you wish to take as a business owner. Now we're going to move on to your balance sheet. This is also known as a statement of financial position. However, it is the same report in itself. Your balance sheet provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years, or you may want to look at quarters or months, and you can track the strength of the business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. And as we've seen in the last year and a half of the COVID-19 pandemic, I've seen many businesses with strong balance sheets weather the storm, and those with weaker ones and potential negative equity, or where their liabilities are greater than their assets, not really survive it quite so well. Your balance sheet can also provide a basis to calculate key ratios such as debtor days and inventory days. So now we're just going to look at a template balance sheet that, again, I have downloaded from the Inform Me website. So here is the Inform Me balance sheet that I've downloaded from the Inform Me website. As you can see, it's broken down into assets and liabilities. In some software, you may also see a statement of equity at the bottom, which will demonstrate how much equity is in the business and how much the owners can withdraw in the form of dividends. In each of the assets and liability sections, they're broken down into current and non-current. Current is those that you would expect to see being paid or received within the next 12 months, and non-current would be longer term. So as you can see under the current assets, we've got cash and cash equivalents. This would be your bank accounts mostly, any merchant accounts, for example, any card readers or sort of direct debit accounts that you might have in your business. Short-term investments, accounts receivable, so that is invoices that have been sent out but haven't yet been paid, any inventory or stock that you have on hand, and any prepaid expenses in your business. Underneath that, we then have property, plant and equipment, and any other assets. So I've also given a figure here for computer equipment. You may also have some furniture, some desks and chairs and so on. And you may also have some intangible assets if you have invested in any branding or you have purchased any goodwill when you took over a business. Over on the liability side, we have current liabilities and non-current liabilities. Your current liabilities are those that are going to be paid within the next year. So it may be credit card debt, any short-term loans, any accounts payable. So again, those are bills that you've received into the business, but you haven't yet paid to your suppliers. Any expenses that you know have been incurred, but have not yet been invoiced to you. And also any taxes payable. In this situation, we have VAT and PAYE. You may also have corporation tax if you're a limited company. The longer term liabilities are going to be longer term loans. In this situation here, I've put in a £14,000 loan. I think many people in the last year will have taken out a bounce back loan. And so I felt it was important to show this on the balance sheet. You may also have mortgages if you have purchased a building through your business, and any other longer term loans such as directors' loans or investment into the business. As you can see here in this situation, the total liabilities do in fact come in at less than the total assets, and therefore the business is just about solvent. So first of all, we're going to look at the net assets on your balance sheet. This is calculated by deducting your liabilities from your assets, and you will have your net assets figure. If this is a positive number, you're in a good position. A positive number indicates that the business has enough assets to cover the costs of the liabilities in the business. If this is negative, why is that? It may be that you have taken on a loan or extended your overdraft. If you have a forecast in place and know how this will be spent, you don't need to worry. But if you don't, you might want to consider making a plan, understanding why the additional credit was needed to ensure that you aren't just filling a hole in a leaky bucket. Make sure that those assets can grow and your liabilities can reduce, and you have a way to pay off those liabilities over time. At times of uncertainty and crisis, the higher the amount, the more likely the business will be able to weather the storm. So obviously, in businesses with a higher net assets figure, this is going to protect them in the longer term, in times of crisis. The next thing you can look at on your balance sheet is the liquidity of your business. This is often called the current ratio, and it's a way to identify how easy your cash situation can be turned around. It's calculated by your current assets divided by your current liabilities. So your current assets, again, they could be your bank accounts, your accounts receivable, divided by your current liabilities. So again, this would be accounts payable, credit cards, short-term finance, and so on. If this number is less than 1, you could be in trouble, and you should seek some guidance as to what can be done to improve the situation. Ideally, you want to aim for a number above 2. This would mean that you have twice as much liquidity and assets than what you owe in liabilities. That being said, if you've got too high a number, it could suggest inefficient management of assets. It helps to compare this number against others in your industry if you can obtain this information. We're just going to go and look over at our balance sheet spreadsheet so that you can see what these figures look like in a real report. So looking at our balance sheet template again, in order to calculate the liquidity on your balance sheet, you take your current assets figure and you divide it by total current liabilities. So in this example, we would be dividing £19,487.23 by £10,501.27, and we will get a figure, using my calculator here, of 1.85. Now, as I mentioned, the figure that you want to aim for is above 1, well, it's above 0, and around 2 would suggest that you've then got double the amount. So actually, in this position, the liquidity is pretty healthy in this business. So in order to calculate the debt to equity ratio, we would take the total liabilities and divide this by the shareholder equity in the business. Now, in this example, we don't have a statement of equity. However, you would take your total liabilities here and you would divide it by the shareholder equity figure from your report. This may be taken from a software example, or something else. But as long as the figure is a relatively low one, you want a low number to show that the business is funded more by the shareholders and less by debt. Next, we're looking at the balance sheet, debt to equity ratio. This is calculated by dividing your total liabilities by the shareholder equity. What does this look like? The lower the number, the better. A high ratio suggests the business is funded mostly by debt. A lower number shows it is funded more by the shareholders and is therefore likely to be more sustainable in the longer term. Debt is often required, especially in the early years or in periods of growth and transition. However, high debt can put the company at a higher risk, and it's important to fully understand why your ratio is the amount it is. If you know that you're in a period of rapid expansion, you would expect a higher number. However, it will generate more revenue in the future, and therefore you know that hopefully over time this will balance out. So in order to calculate the debt to equity ratio, we would take the total liabilities and divide this by the shareholder equity in the business. Now, in this example, we don't have a statement of equity. However, you would take your total liabilities here and you would divide it by the shareholder equity figure from your report. This may be taken from a software example or something else, but as long as the figure is a relatively low one, you want a low number to show that the business is funded more by the shareholders and less by debt. So to summarize, the 5 key points to take from this video are: check your sales. Are they what you expected? Profit margins. Are these correct? Net assets. Is this a positive number? Liquidity. Is the business liquid? Do you have enough assets to cover your liabilities? And finally, debt to equity ratio. Does the company have enough equity to cover its debts? You want a number between 1 and 2 to show a healthy balance sheet. Now, as with many reports, there isn't really a right or a wrong, as long as you understand the figures and why they are the way they are. A business that is making a loss is only a problem if the owner doesn't take action to improve this position. There are plenty of reasons why a business may be unprofitable, have high debt or low margins, especially in the early years. Knowing your numbers and how to interpret your financial statements is key to feeling empowered to be able to make the right decision for your business and take it forwards to the next stage. And finally, some other resources that you may want to look at to help understand your financial statements. First of all, remember that your accountant should always be your first port of call for any questions. If you think something needs to change in your business, consider discussing this with them and how you can work with them to change or improve your position. The Inform Me website is full of helpful resources, templates, and articles if you don't have an accountant. And as a reminder, the AAT Business Finance Basics course is there to help you on your way and give you a great grounding in some of those financial basics for your business.